Good evening, friends. Today we are coming to some of the few last parts of the subject money and banking. More importantly, we are going to study today monetary policy. Monetary policy, simply put, we mean to say by policies that are determined by the central bank authority of any country. In our case, it's RBI, who decide about the nitty-gritties, the ifs and buts, the this and that of money supply to be made available with public for consumption in an economy. To be precise, to be very precise, firstly, let us be very clear that who formulates this policy. Monetary policy is related with, as the name itself suggests, with money. Now, with respect to what? With respect to supply. Now, how does it do that? Monetary policy, what exactly does it do that? Does it only say, okay, this much is the quantity of money that is to be made available with the public? Or this much only is needed for consumption or circulation amongst the public? What type of money is needed, when it is needed, and how it is to be done? All these things they are taken care of with respect to monetary policy, which is formulated by the central bank authority of any country. Now, what exactly is monetary policy? Monetary policy is an economic policy. It's not financial policy. Let us be very clear about it. Financial policy is related with financial management of revenue and expenditure, that is fiscal policy, right? Now, to give you a brief idea about what is the difference between fiscal policy and monetary policy, fiscal policy is that policy that is related with financial management. That is, if there is more of revenue than of expenditure, how to manage that, or more of expenditure than of revenue, how to overcome that. That policy is what we call it as fiscal policy, whereas monetary policy is an economic policy. It affects the economy. Of course, monetary policy can also affect fiscal policy, right? Why and how, sometime later, that we can discuss. But the issue that is to be understood very well here is monetary policy. That is, it's an economic policy that manages the size and the growth rate of money supply in an economy. Size, how much money should be supplied in the economy, and at what rate. Supposing you might say, okay, you want to push this much of money into the economy, and you want to push this much of money quite frequently or periodically or once upon a time. That is what is done with respect to monetary policy. How much money is to be pumped, when and why it is to be pumped. These are the three questions rather, that are answered with respect to monetary policy. Now, also, it's a regulating tool of macroeconomic variables. Macroeconomic variables like inflation and unemployment are regulated by monetary policy. How? Now, what is inflation? Inflation, more money chasing few goods. Now, why there is more money? Because the interest rates have come crashing down. That is why there is ample amount of money available with the public to spend. Now, what do you do that to control? You suddenly increase the interest rates so that there is less money available for spending with the public. Increase on loans, decrease on, that is, increase the interest rates on loans as well, and at the same time you try to manage inflation accordingly. Now, how does money supply affect unemployment? Say if there is unemployment in the country, unemployment might be because of two reasons. Cost of investments might have gone up, hence the industry is not willing to spend. Spend means they are not going to add, they are not going to expand, they are not going to merger, acquire new companies, bring in new technologies, and also because of the income levels might have come down, and hence there is unemployment. Now, how do you pick up unemployment, or how do you beat unemployment? You try to make the cost of borrowings relatively cheaper so that people invest, right? Say cost of borrowings means cost of loans, and at the same time you make cost of deposits also that is, you make deposits attractive by increasing the interest rates on deposits. If you do these two, what happens is the interest rates have come down, people are inclined to invest or spend, and at the same time banks get money into the system so that they can also lend. So that is how. Then what happens? Cost of borrowings, if they come down, people make investments. There's a lot of industrialization going on, a lot of industries open up. If they open up, there is employment, and thus unemployment can be beaten. So it also is a regulating tool for these, that you can regulate inflation as well as unemployment in that case. Now, it's implemented through different tools that we are going to study very specifically later on, but broadly, like I told you, monetary policy is a tweaking of interest rates, adjustment of interest rates. That is one aspect of monetary policy. Second aspect is that if, say for example, if money is not available within the hands of the public, how does the government make available with the public? It either spends on infrastructure, and that is how the money comes back. Or you can also do by purchase and sale of government securities. You buy government securities, government has money, and that money comes back again into the system for the public. Or you sell government securities, again in that case